Best in radio. It's all about what's next. Go to financialsurvivalnetwork.com and sign up for your free weekly newsletter. You'll also get 3 free reports. The Financial Survival Network. It's all about what's next.
And welcome. You're listening to the Financial Survival Network. I'm Kerry Lutz, and it's Monday, March 16th. And that means it's time for John Rubino. John, how are you?
All right, Kerry. How you doing?
All right. So what have we got going on today? Lots of chaos, huh?
Lots of economic news today. And it almost all of it follows the same theme, which is that the U.S. is slowing down, that this recovery is to the extent that there ever was one, it's petering out. Some examples. The U.S. manufacturing output fell in February, which is the third straight month of declines. And the biggest declining element was auto production. And that's been the strongest part of the manufacturing economy for the last year because banks were writing all those subprime auto loans. Well, apparently that's kind of run its course. And now the market is kind of getting back to normal, which is to say slow in this environment. And a forward-looking gauge of manufacturing, which is the New York Manufacturing Index, also came out this morning, and it covers this month rather than previous months, and it fell to the weakest level since November 2013. Meanwhile, oil is down about 4% today, which is a huge drop for a big commodity like this. And Brent crude, the U.S. oil index, is down to about $43 a barrel, which is the lowest it's been since the depths of the last recession. And last but not least, the home builder confidence index came out today, and it was down to the low level since last summer. That's an index that measures how optimistic home builders are. In other words, are they saying lots of people coming in and saying, "Hey, build me my dream house," or not? And it appears to be not right now. So all of that together paints a picture of a slowing economy that was recovering a few months ago or seemed to be moving in the right direction and now starting to roll over. And another couple of months, like the last couple of months, and you've got to be talking about recession again in the U.S. Now, the only statistic that contradicts this continues to be employment, because this morning, the measure of new jobless claims came out, and that was down, meaning that fewer and fewer people are applying for unemployment insurance. And that is kind of the outlier. And it would be surprising if that one stat continued to improve while everything else is turning down, especially considering what's happening in the oil patch. If oil is tanking, that means all these good jobs that were created by the boom in fracking and just generally strong oil prices of the last few years are being reversed out now. So we're seeing hundreds of thousands of layoffs in the oil patch, which should, over time, offset whatever gains there are in, restaurants hiring new waiters and corporations hiring new temps and things like that. And, McDonald's is probably hiring new people part-time for $7 or $8 an hour. It's the part-time side of the economy is counted as the same importance as full-time jobs in government statistics. And that's a misleading way to present employment numbers, but the government does it anyhow. So we have to kind of read into the government numbers and read between the lines and understand what's happening there. So add it all up, and the U.S. is consistently missing expectations for a lot of its economic reports. In fact, Bloomberg just published something last week showing that the U.S., in terms of meeting the expectations of economists with economic reports, is the worst leading economy out there. We're disappointing the economists who are trying to predict what kind of numbers we're going to generate very consistently right now. And that can be traced back to the strong dollar. The currency war thesis is that when a country lowers the value of its currency, that improves its ability to sell stuff to the rest of the world, helps its economy, it tends to grow more, and generally it tends to benefit at the expense of its trading partners. Well, we're on the losing side of that right now because the dollar has gone way up in the last 6 months against most of the world's other currencies. currencies. So according to the currency war theory, we should be suffering. We should be having trouble selling things abroad, and our economy should be generally slowing down. And that's exactly what we're seeing. So then the question becomes, how much longer can the dollar continue to increase before the pain becomes unbearable? And we have to shift gears and do something to devalue the dollar. And I would argue, based on the numbers that have been coming out lately, is that we're reaching that point, that the numbers are just so bad and so disturbing and so close to recession in a lot of different areas that that is an unacceptable possibility to the guys running the U.S. economy. We can't drop back into a recession, or with all the debt that we've taken on, a recession can easily become a depression now. We have to grow and we have to inflate, or the leveraged speculating community, which is basically the whole country now, will implode. And so let us have another 2 or 3 months like the last 2 or 3, and we're likely to see a serious about face in monetary policy and fiscal policy at the top levels of the U.S. And we might jump right back into the currency war. We might go right back to QE and start monetizing debt on a big scale. And so then the whole world will be doing that. And then we'll see what happens.
Yeah, well, how much lower, but can they cut interest rates? I mean, what's the 10-year at now, John? It went
10-year in the U.S. is below 2%. Yeah, but in other countries, it's close to 0, and 5% or 5-year bonds are negative interest rates now. So that's a big intellectual debate in the economics community now, because it used to be thought that interest rates can't go below 0, because then why would anybody ever accept that deal when you can just hold cash, which doesn't lose its value? Right? Cash doesn't cost you anything to own. So why would you put your money in, say, a bank account or buy a bond, which actually costs you money year after year, when you can just hold that cash under your mattress and at least not have to pay anybody for the privilege? And yet people are taking that deal. They are buying bonds that have negative interest rates. They're putting money in bank accounts that have negative interest rates. And around the world right now, there are maybe $2 trillion out there of bonds that are trading, which means they're being bought in the open market with negative yields. So the economics profession is trying to figure out how this is possible and come up with some kind of a framework that gives them some idea of what the real lower bound for interest rates are, since 0 didn't turn out to be real. And there's no consensus yet, as far as I know. So we really can't say, it can never go below 1% or 2%. We just don't know that. There's no theoretical framework that we can base that kind of a prediction on right now. So, and of course, the reason that interest rates are falling is that governments have basically used up all their traditional tools for managing the economy by lowering interest rates. That used to be the main monetary policy tool, or it still is. And we've reached 0. And so they've just kept on going. They're just lowering interest rates below 0 because they have nothing else to do. They don't have any other tools. When an over-indebted economy starts to tip over because all that bad debt starts going bad, there's really nothing left to do but push interest rates down even further in the hopes that money that is free, in other words, if you borrow money and don't have to pay anything for it, maybe you'll borrow a lot of it and then you'll spend it and the economies of the world will grow. And we'll see. There might be a point down there where interest rates are negative enough to cause consumers and businesses around the world to really ramp up borrowing and investing. Now corporations, of course, are doing it already, but they're not doing it to invest in new factories. They're doing it to buy their stock back, because you borrow money at 0 and your stock is yielding 2%. You buy the stock and retire it. You save the 2%. So it's a cash flow positive activity. But they are not building new productive capacity and improving the ability of the economy to produce more stuff going forward. That's not what's happening. So the ZIRP, zero interest rate policy, and NIRP, negative interest rate policy, that's in place around the world now, is not bringing the desired results by and large. So we'll see what these guys do next. But right now, you got to figure that they're kind of flailing. They're sitting around their conference tables and just tossing out ideas and not really coming up with any coherent plans, because nothing that training has told them should work has worked. And so where we go from here is kind of uncharted territory, but it's fascinating to watch.
Running out of options, aren't they?
Yeah. Well, they seem to be. And so the question is negative 5% interest rates. Is that an option? And if it is, then they're not out of options. They can keep on pushing rates down and seeing what happens. But according to traditional theory, they ran out of options a little while ago, and so now what they're doing is just experimental. They're trying stuff and seeing what happens without any real theoretical framework implying that one outcome or another is more likely, because who knows? We've never been in a world where nominal interest rates around the world were this low. So we can't use history as any kind of a guide to tell us what's going to happen. I will say one thing, though. Theoretically, if cash, from a cash flow standpoint, is better than a bond, then you would think gold would be an even better deal, because it has the same cash flow characteristics as a bank account right now. You have to pay to store gold, or you can store it at home like cash and not have to pay anything, which used to be a drawback versus a bond that yielded 6%. Well, now that bonds are yielding negative 1 or 2%, then all of a sudden, in cash flow terms, gold is a better deal. So you would think that gold would be benefiting from this, and it's not in the U.S. But if you look around the rest of the world, Goldcore just published a fascinating chart that showed gold over the last 15 years, since 2000, in a lot of different currencies. And what happened was gold went up against everything up until 2013, and then it tanked. Then it had a correction, which you would normally expect after years and years and years of going up year after year. And but then, since the 2013 correction, gold has turned around and gone back up in every major currency except for the dollar. So in every major currency, the bull market is still intact. And after a completely normal correction, the bull market has resumed. Only in the dollar is gold down in the last couple of years. And so the gold story is really less about gold and more about the US dollar. The dollar has become the world's safe haven. All kinds of capital is flowing into it, and it's going up even against gold. But gold is going up, meanwhile, against all these other currencies. The other currencies of the world are continuing to fall against real money. And so if you're anywhere else in the world, gold is still in a bull market. Only in the US do we feel like it's in a bear market. Everywhere else, you're still making money in gold. And so then the question becomes, with the dollar soaring and us suffering because of a strong dollar, as we talked about, all these economic stats are coming out below expectations and trending towards zero, or they've already dropped below zero in the US, which would normally lead a country to devalue its currency, especially in a currency war world where that's expected. There's no real shame in doing something like that. So if we turn around and join the rest of the world in trying to devalue our currency, and we succeed, which would mean the other currencies go up now versus the dollar, then you'd expect gold to go up dramatically in dollar terms, because the strength of the dollar is the only thing that has kept gold down in dollar terms. So we'll see. There are a lot of cross currents here, but a lot of trends look like they're ready to reverse here, just because the big trend, the strong dollar, looks like it's run its course, because we're starting to feel so much pain from it. So the second half of this year should be different from the first half. We'll see.
And so they can only hold out so long, and then they've got to take action to bring the value of the dollar down, basically. And can they do it is the question. Yeah.
Well, they can definitely do it just by ramping up QE again. And our interest rates are actually higher than many other interest rates around the world now. As low as they are, they're higher than Germany's rates or Japan's rates. And so people buying what they perceive to be high-grade bonds, fairly safe pieces of paper, can make an extra % or 2% a year by buying U.S. Treasuries versus German Bunds or Swiss franc denominated bonds. And so it's no surprise that money's flowing into the U.S. with our interest rates being relatively high. So we could cut our interest rates and redirect those capital flows to these other safe haven assets, and that would push the value of the dollar down. So yeah, we can still do it, but again, then you're getting into really experimental kinds of crazy sounding policies where for us to push the yield on say, 5-year treasuries, which is one of the world's safe haven assets. It's the debt of the government that runs the world's reserve currency. And if we push that down to zero, which we, in this world could do without it being all that remarkable relative to Japan and parts of Europe and parts of the Eurozone and parts of Switzerland, what would that do? 5-year treasuries are at zero. That would clearly make the dollar less valuable relative to these other currencies. But it's not clear what the secondary effects of that would be around the world. I don't know. But that's something we could do since these other countries have done it, and something that we would have to look at doing if we tip into recession because our currency is too strong. And so the next couple of months' economic statistics are, I think, going to tell the tale, because if they turn around and they're strong again, then the Fed is kind of committed to raising interest rates. Raising interest rates. We'll be the only country in the world doing that. And that would exacerbate our problems. That would make the dollar even more attractive, relatively speaking, drawing more capital, push the value of the dollar up even further. And then we would suffer even more dramatically from an overvalued currency. So there's no way out of any of this. This is all just kind of a back and forth thing with a zero sum. Nobody ends up winning in a currency war. You just disadvantage your trading partners for a little while and reap some rewards, but then they come back and respond in kind, and then you're disadvantaged and they're making out. And so right now we're the one that's being disadvantaged, but we can't keep this up for very much longer. Kerry, there's one other thing that's really interesting that happened to me in the last couple of weeks, is that I listened to the audio version of a book about World War I, and specifically about the kings who were in charge back then. It turns out they were all related to each other, and most of them were utterly incompetent. These governments were horror shows. And they, the mistakes that they made led to this catastrophic war. But one thing that never gets mentioned in that book is monetary policy. You never hear the central banks of these countries mentioned. You never hear the names of the central bankers. And that is because monetary policy was not an issue back then. They were on the classical gold standard, and their money was basically just warehouse receipts for gold and names for different weights of gold. So they didn't have inflation, and monetary policy wasn't their main economic lever that they were constantly fiddling with or anything. And in that sense, that was a much saner, better run world. Economic growth was fairly consistent, and these countries were getting richer and richer, and the mistakes they made were largely mistakes of stupidity, and not structural mistakes where the monetary system was out of control the way it is today. And so I just thought that was fascinating, that the world has changed so much in 1 century to the point where central bankers are running the world. These guys are the celebrities in their countries. They're the most powerful people. And we're so dependent on Fed minutes where we parse the statements and try to decide what patient means. This is like back in the days of the Soviet Union, where we had Kremlinologists that tried to read all the statements of the Politburo and make sense out of it. And so I think that our world would be much better if, at least in that sense, that our monetary policy was like the classical gold standard in some way, so that central banks just couldn't manipulate the world the way they are now. I think we're making a set of mistakes that's kind of the mirror image of what those guys made back then. We elect our governments, and some of these guys are completely incompetent, but they can be recalled, and so there are some checks and balances in terms of who's in charge, but there are no checks and balances in terms of monetary policy. Our central banks today are completely out of control, whereas back then they were totally under control. They were almost irrelevant because money was gold, was outside the control of governments. And because of that, they had no inflation and steady growth, and monetary policy was not their problem. It's possible to have other problems under a classical gold standard type system, but inflation is not one of the problems that you have to deal with.
Right. And basically, the other problem that you don't have to deal with so much is manipulation. Assuming that the world's central banks are actually in check, meaning that the number of the certificates, the warehouse certificates, which are actually bills, not notes. Bills are actually evidence of gold on deposit with that central bank, with that warehouse, it's a receipt, then there's nothing else for them to do. Notes, on the other hand, are evidence of indebtedness of the central bank. They put out these notes that we all know and love. Our greenbacks are just notes, which are evidence of indebtedness of the central bank. And then it opens itself to all sorts of money mayhem, as our favorite Milton Friedman called it. But if they're really bills for bullion that are on deposit with the big warehouse there at Liberty Plaza, then there's nothing else for them to do. But then you get down to, well, is a time deposit, can you just put out notes for that? Gives you kind of intellectual discussion what that should be about, but we don't need to get into that because it doesn't matter now. But really, that was never a part of the equation. That's never money that's tied up, that's loaned out or whatever, isn't really considered that real money that's in circulation, that's backed up by actual gold. But once that time deposit's up and can then be converted into actual bills, then that needs to be backed up by gold. But we don't have to worry about these little niceties, John, because that system doesn't exist anymore, and these central banks are the ultimate arbiter of what's in the money supply and what isn't. But in any event, it's all going to get very interesting very fast one day soon when they reach the end of the line, which is coming. But in the meantime, John, you got to go. I got to go. So find John's work at dollarcollapse.com. Make sure you check out his book, The Money Bubble, that he co-authored with another of our favorite guests, James Turk, goldmoney.com. And don't forget, check out our site, which is financialsurvivalnetwork.com. Make sure you sign up for the newsletter and for the upcoming series of webinars, which we are putting together right now. John, we will talk to you next week. Thanks so much.
Thanks, Kerry. See ya.
FSN Radio. It's all about what's next. Go to financialsurvivalnetwork.com and sign up for your free weekly newsletter. You'll also get 3 free reports. The Financial Survival Network. It's all about what's next.